What's going on, achievers? In this video we're going to talk about what is the stock market and how you can obtain money on it, explaining basically what is a share, how much money you need to start and where you can pick the stocks, what determines the price of a share and why it moves over the time, different strategies that you can take, how to choose a winning company, different learning resources to help you on the learning process, and also different passive methods if you don't want to put a lot of hours on it. And finally, some taxation basics. So we have a lot to discuss. Let's start it. Alright, so what is a share or a stock? A share basically is a small portion of ownership from the underlying company that you are buying. So this is the mindset that you need to have. Instead of the amount of shares that you are picking, you are taking part of that company. So it's very important that you understand how the company is producing money and the future it has their vision, and also the different risks that they can experiment. And those shares basically are held over the world from different investors, and these shares are exchanged on the different markets. And maybe if it's a USA company, it's traded on the New York Stock Exchange, or if it's a Japanese company, it's on the Tokyo Stock Exchange. And those markets are open Monday to Friday on the work hours on that particular time zone. And the important thing is that any famous company that you can think on your mind, if they are publicly traded, because not all of the companies are on the stock market, you need to take a look on that. Basically, they have big amounts of demand, and you can buy or sell this company in just 3 clicks and a few seconds. And to do that, you need what is called a brokerage account. And a broker basically is the intermediary company, and they allow you to buy or sell your positions. And if you live here in Europe or in UK, I really recommend you the Giro. That is the one that I've been using the last 4 years. And I'm very happy with them because they have the lowest fees in Europe. And if you want to give them a try, I put a link on the description box below where you can obtain 20 euros for free to start investing. And if you live in the USA, I recommend you Robinhood. And I know different people that are from there that are using it, and they're very happy because the system has free commissions. And I hope that someday here in Europe, the Giro or another broker offer those types of services. And to start investing, honestly, you don't need a lot of money. You can start with a few hundreds of dollars or a few hundreds of euros, and you can buy some big corporations. For example, AT&T, that is a very big corporation in USA, and particularly it's one of the companies that I hold. Now I think it's trading around $30 a share. So imagine if you put $300, you can pick 10 shares of this company. And like this one, there are too many good opportunities there. And if you are always thinking, I will start investing where I have saved that amount of money, you probably will not finally do it, and you will delay it, and you will miss so big opportunities. And I think that it's very important to start small, because if you screw up, you will only lose a small portion of your entire portfolio. And basically you're paying to gain experience. And I think that this is the important thing, because you can't learn all reading or taking courses. You need to take action. And what determines the price of a stock? Basically the price is updated every time a transaction occurs. Every time a buyer and a seller agree in one particular price, the price of the stock is updated. So if the market is open, you will see a lot of volatility and a few cents up, a few cents down, and it's a normal thing. This means that there are a lot of volume and a lot of transactions going on. But also another thing that you need to understand is that the price of the stock, it doesn't represent the actual value. For example, a $20 stock can be extremely more expensive than the one that costs 700. Okay, so as we will see on the point number 5 on how to choose a company, there are a lot of things to take in consideration. For example, apart from the fundamentals of the company, the political situation, the overall economics, those are things that take a very big role on the stock market. And also the sentiment and the psychology of the investors, because it's like a cycle. Sometimes they are positives, sometimes they are negatives. It's a pendulum all the time. And also there are some technical analysis stuff that it's more advanced, but on the beginning I don't recommend you to invest a lot of time looking the graphs. And due to this volatility, you can have different strategies. For example, you can do day trading. And basically with this strategy, you are holding the stock just a few minutes or a few hours, and you are willing to obtain small gains by repeating the process over and over. And I think that this is not a very good strategy because it's so time consuming, and it's studied that the majority of people lose money on doing that. So I think you need to be very focused if you want to do that strategy. A different approach could be doing swing trading. And here basically you are holding the stock a few days or a few weeks, and you are very focused on one particular event that is going to occur, like an earning report or maybe a launch of a new product. And I think it's a better approach than the first one. But I think that there is a lot of risk too, because it's very difficult to predict the future and be sure that the things will go like you think. And the third approach is doing long-term investing. And it's the one that I use the most. And basically here you are holding the stock for different years or decades, and it's decided that this system is the best over the past of the years, and it's used by very famous investors like Warren Buffett. And the beautiful thing of this is that apart from obtaining gains on the appreciation of the current stock, some established companies paid what it's called dividends. Okay, dividends. And what they are basically a recurring income that you are obtaining just for holding the stock. And the interest rate depends on the company. Some companies just start paying dividends and start like 0.7%, but some big corporations like AT&T that I told you, it's like around 7% of the dividend yield, that it's called that interest rate. And imagine holding the stock over different years, the big amount of money that you can create. And if you don't know and you don't understand the power of compound interest, you can take a look here, and I did a video explaining more in depth this. So how we can choose a winning company? To be honest with you guys, it's very difficult to resume all the factors that you need to take in consideration in one small video. But one of the most important factors that you can take a look is, for example, the PE, the price earning ratio. And this indicator basically tells how much you are paying to obtain the earnings that the company is producing. And this will help you if you want to compare different companies on the same sector. For example, if you are into the technological companies, nowadays it's around 16, the average. And if you see some company that are less than that PE, you can find some value there. Also, there is the forward PE, that it's an indicator that takes in consideration the future prospects of the company. So you can see if in the future it will be more expensive or more cheaper than the actual price that you're paying. Also, a good indicator is the market capitalization, and it's basically the amount of money that the company represents. And as higher it is, the company is more established. For example, Amazon and Apple the last year reached like $1 trillion, so imagine that amount of money. And normally those companies are called blue chips because they are more established and they often have less volatility and they are more safer. Apart from the fundamentals, for example, you can take a look on the graphs and the technical analysis. And one small introduction is that, as you will see, all the graphs have some resistance and some supports on the bottom. But I don't recommend you to take too much look on the graphs in the beginning. And apart from it, you also can take a look on the overall opinion on the different analysts, because you will see a lot of news and a lot of reports studying what the company can do in the future. But it's also like an additional information, but I don't recommend you to take a look on all the noise. It's also good that you take a look on the investor relation page that every company has on their webpage, and there you can find the quarter report and the annual report, and you will understand how the business works and the different aspects that they are producing and how they are going to protect themselves over the different risks that can occur. And also take a very good look on the balance sheet, because if the company has big amount of cash on their backs, they will probably be good when rough times occurs. And in terms of learning resources, I recommend you to subscribe to this channel, Growth Mindset, and we will talk about all of these topics more in depth and also more advanced stuff. And also, apart from this, I recommend you Investopedia. It's a web where I learned a lot, and they have a very good dictionary that will help you to understand all of these financial words that maybe in the beginning you say, what is that? And apart from this website, I recommend you some different books that are bestsellers on the financial world, like The Intelligent Investor and Think and Grow Rich, and you can check on the description box below. And maybe in the beginning you see too many factors to take in consideration, and you don't want to put a lot of hours on the investing world, and it's totally fine. And the good thing is that you can still obtain some benefits on the overall market, and you can do this using what is called indexes and ETFs, that basically are trackers that tracks those indexes or some different companies. And one of the most famous ones is the S&P 500, that basically tracks the 500 most capitalized companies in the USA. So if you hold that index, you are diversifying your portfolio over different sectors, and this is a good strategy. And it's studied that if you have portions of your portfolio in different industries, you are protecting yourself and you are reducing your overall risk, because sometimes the investors change their money to one industry to another one. So it's good to have a small portion on different ones. And also there are some trackers that tracks companies in different regions of the world, and it's good also to have a diversification on geography, because sometimes some economical crash can occur on one particular region, and owning those trackers will help you having more protection. And a good thing to do, and it's the strategy that I follow, it's to have some individual stocks, but also some indexes and some bonds, some passive ways of investment. And I think that doing that, you are reducing your overall risk, because it's difficult to always pick winning companies. Sometimes you will have losses, but yes, other times you will have some big companies, some winners that are producing very good returns that are extremely better than having, for example, the S&P 500. That it's good too, because on the past decades it's producing like an average return of 7 or 8%, and you will also obtain dividends, so perfectly fine. But I think it's good to have the both sides. And in terms of the taxes, what you need to understand is that you basically pay only when you sell your position, never when you buy. And also you will have to pay when you are obtaining some gains on your dividends, but you can avoid this if you use what is called a DRIP. That is basically a reinvestment of your dividends, and you program your brokerage account to reinvest all your dividend gains to the actual stock. And the actual percentage that you need to pay in taxes depends obviously on the region that you live, so you need to take a look. But for example, in the USA, if you live there, you have some advantages if you are a long-term investor instead of a short trading. And here in Spain we don't have that, but for example what we can do is compensate our losses to the overall taxes that we have to pay for our winning picks. And this was my introduction to the stock market, and I understand that maybe you are overwhelmed on all the things that you need to learn, but it's totally normal and it requires time. But if you are interested and you want to learn more, I really recommend you to subscribe to this channel, and we will talk about on all of these things more in depth. And apart from investing, we talk about self-improvement and entrepreneurship, so I would really appreciate if you can subscribe and give support to this channel. And if you have any question, please let me know in the comments below, and I will do my best to answer all of your questions. And if you haven't watched it, some months ago I made a video on the reasons why you need to start investing and some different strategies apart from the stock market that you can take. So if you haven't watched it, you can check here or in the description box below. Thanks a lot for watching, and I really hope to see you in my next video. Dream big!